Everything turned upside down. A 41-year market vet explains why we are heading towards a 40% collapse as widespread speculation reaches dangerous proportions and says the market is facing 5 to 10 years of negative returns. Bill Smead is tired of everything. All enthusiasm, all monetary relaxation, all price multiple expansions that stand out at the top of the market, all the SPAC hype, despite the ongoing vaccination, all the stay-at-home shares continue to return, all of them. Smead Capital Management Chief Investment Officer of $2.3 billion says it all raises to create a perfect storm that will ultimately upset the market in one of its biggest crashes ever. There are a lot of cases of financial euphoria combined here, Smead said in an interview with Insider on Tuesday. There is a bond section, FAANMG section, homestay section. He continued, everything turned completely upside down. This is an act of stupidity among the most legends of all time. He added that the accident he predicted could rise to second place after 1929. Smead calls for a minimum 40% drop in the S&P 500 and a 5 to 10 year period of negative returns before the market regains its former highs, like the crashes in 2000 and 2008. He refused to give a timeline for the fall, but hinted that this could happen at any moment, and read the proverb, heels are processes. He blames central bank policies for the current environment and warns that a massive inflation wave may be on the horizon, and the catalyst for a collapse amid a booming money supply. The Federal Reserve has indeed promised to allow inflation to warm in the next decade. Unprecedented levels of fiscal stimulus from Congress raise the likelihood of such a scenario occurring, but it is not yet clear whether meaningful inflation levels will hold up. Rising inflation levels mean multiple contractions in price earnings as earnings numbers inflate. But this would also lead to higher government bond yields and therefore investors to avoid the riskier growth stocks that led to the S&P 500 and make up such a large percentage, he said. Even if circular stocks perform better under inflationary pressures and there is an economic recovery in the future, Smead said that since the performance of these stocks is relatively small, it will not have much of an impact on the overall performance of the market, the proportion of the S&P 500. Is there something like 12% or 14% of the S&P market share in the smallest 250 companies? There could be great success out of the bottom 250 companies and probably not make money for people who own the index, he said. There is no room for anything but disappearances for more than 5 to 10 years. Although Smead argued that the wider market would see quiet returns, stocks for recovery are on the rise. He said that people should buy these securities now with the expectation that the economy will reopen. Last week, AMC noted at the enthusiastic frenzy that pulled its shares into the stratosphere, saying it was a bit of irony as he thought it would be fine in the coming months and years when vaccines were distributed. The best investments are for what you cannot do, not what you can do, says Smead. So the irony is not where they got AMC, but the rise of AMC actually make sense because cases are falling off the cliff and the vaccinations are super successful. Smead's views in context, Smead's rise in the recovery trade, and concern for potential inflation are not necessarily out of ideas. Many strategists see medium to long-term gains for cyclists as the economy improves, and the Fed itself signals higher inflation in the future. But Smead's call for a steep 40% drop is towards the margins of the market outlook. While some, such as Morgan Stanley's chief U.S. capital strategist Mike Wilson, said recently that the markets had a short period of underperformance, he and others are seeing an upward path next year. And even if inflation comes in, this year is not expected. Wages are unlikely to rise as the job market makes up for losses. I think you will see inflation rise in the future. I don't think inflation is out of fashion forever. I just don't think it will happen this year. And so, Northwestern Mutual's chief strategist, Brent Shute, told Insider in January the rest of the year. Still, predicting the future of the market can be a futile exercise. While Smead's views may not be widely shared and realized, it does make a case worthy of attention as investors' sentiment and valuations are at high levels. Brent Shute, chief strategist of Northwestern Mutual. Meanwhile, Shute does not think it will rise in 2021, but he thinks the possibility of inflation is a more credible threat. To prepare for the odds, the Treasury opts for inflation protections such as inflation-protected securities and gold. We have the tips. You're clearly trying to hedge when building your portfolio. Therefore, we recommend our consultants to have their own tips, especially when the front end of the curve is with nominal interest rates. Customers trust, he said. We have short-term tips. They have a high correlation with unexpected inflation. We believe in gold more than Bitcoin, he continued. Imagine that. Inflation is likely to rise. The central bank will try to settle on the rates. For me, negative real returns, negative real rates. And for me, gold will be the asset class that can react positively. Nancy Davis, founder and portfolio manager of Quadratic Capital. Davis says the market is skeptical that the Federal Reserve can reach inflation of up to 2%. Ignore the possibility of runaway inflation. There's not much belief that the Fed can actually increase inflation. She said volatility in interest rates, fixed income volatility, is lower than in the summer. Davis manages a portfolio designed to profit from inflation expectations and interest rate volatility. She trades as an ETF under the name LVOL. He argues that even if investors do not believe inflation is about to rise, they should ensure that their portfolios are protected against it, and that they cannot achieve this goal simply by purchasing a bond benchmark such as Barclays aggregate bonds. David argues that any fixed income asset is ultimately long-lasting, and that will be a problem if they were wrong about the Fed's effort. Lindsey Bell, chief investment strategist at Ally Invest. Bell doubts that inflation will rise about 2% to 3% anytime soon, and that even the upper limit of this range will be lower by historical standards. I think it might add some volatility to the market, but I'm not in the camp expecting inflation to stay warm for a long time, he said. Still, investors suggest that they hedge against a modest rise in inflation by purchasing consumer fundamentals, energy, and financial stocks. She explains that household furniture manufacturers are in a good position to raise their prices if their costs rise. Inflation is often associated with high oil prices, which is good for energy companies, and higher interest rates, which help banks and insurance companies. If inflation rises above 3%, the strong and sustained wage increase is likely to blame, Bell says. For this reason, he advises investors to keep an eye on wage growth statistics and emphasizes that they should not panic, even if inflation is rising slightly higher than it has been for a long time. She says that in the face of constant inflation, they should consider converting some of their investments into real estate, gold, and treasury inflation protected securities other than stocks.
If you make any investment or legal decision, it is advised to consult an expert before making this decision.